If you're thinking of co-signing a private student loan for your college-bound child or grandchild, you might want to do a little bit of research first. With the cost of higher education on the rise, students and their families are borrowing more than ever. But private loans can come with different clauses than federal loans. If the primary borrower stops paying, co-signers are expected to pick up the tab and could soon find themselves fending off debt collectors. Loan lawyer Joshua Cohen offers a word to the wise.
What someone needs to do is they need to do a cost-benefit analysis. Is it worth the risk? And I don't want to say don't take a private loan at any cost. What I want people to think about is, would you make this kind of purchase for anything else?
So what exactly should parents and other potential co-signers look for in private student loan contracts?
People need to understand when they co-sign a private student loan, it's just like co-signing anything else. It's like co-signing a credit card. It's a consumer debt.
Unlike federal loans, which have flexible clauses like income-adjusted repayment plans, private loans often come with pretty rigid plans. Students and co-signers can only miss a few payments before they get into trouble. They also aren't able to modify their private loans as circumstances change. And even worse, students and co-signers could face serious legal consequences if they miss payments.
What happens when you miss a credit card payment? You get a phone call. Same thing happens with a private student loan. And how many credit card payments are you allowed to miss before you're in trouble? The bottom line is, if you miss too many payments, you may get a knock on your door with a lawsuit.
Co-signers should know that private student loans, just like federal loans, can only rarely be discharged by filing for bankruptcy protection. In other words, it can be very difficult to get rid of them. And that extends beyond the lifetime of a student. Many co-signers are still on the hook, even if the student dies.
When a student passes away, their federal loans are forgiven. And if a parent has a plus loan, which is a federal loan that the parent takes out to make up the difference, that parent plus loan is also forgiven. As opposed to the private student loans, each bank has their own policy as to whether or not they forgive a loan if the student passes away.
Because private loans are like any other loan product that banks offer, they can rise over time. Many federal loans have a fixed rate, such as 3 or 7.9%, but private loans can go up to 15%. A co-signer, for example, could see their monthly payments go up by $100 or more. And that could mean the difference between making your loan payments and defaulting. Lenders say that private loans represent an important source of funding for students who don't qualify for federal loans or who need additional funding that the government can't provide. But Mr. Cohen says that parents still need to make sure that they know what they're getting themselves into.
Now, education is very different than buying a house, a car, or even a stereo. But you still have to think down the line. You have to think of this as a real purchase. It's different than it used to be.
For the Wall Street Journal, this is Thuy.